Right now, military planners around the world are asking a quiet but urgent question. If tensions between the United States, Israel, and Iran suddenly escalated, who would actually run out first? Missiles, interceptors, or money? Because in modern warfare, the outcome is often not decided by the first strike. It is decided by the math of interception. And tonight on Crisis Clips, we are looking at the numbers that defense analysts believe could shape the entire outcome before the first week even ends. For months, geopolitical tension across the Middle East has been simmering just below the surface. Iran continues expanding its missile arsenal. Israel maintains one of the most advanced missile defense networks on Earth. And the United States has quietly reinforced its naval presence in the region. Public statements remain cautious. Diplomatic channels remain open. But behind closed doors, military planners are running simulations that all revolve around a single concept: interceptor saturation. Disclaimer: this video is a strategic analysis and hypothetical scenario based on publicly available information. It is not real breaking news and does not report an actual war event. The idea is simple, but its consequences are enormous. Modern missile defense systems are incredibly effective, but they are also incredibly expensive and limited in quantity. Every incoming missile must be matched with an interceptor, sometimes two, sometimes three. The moment incoming volume exceeds interceptor supply, the defense system begins to leak. Now imagine the scenario many analysts quietly discuss. What if tensions suddenly escalate within the next 48 hours? In this hypothetical timeline, a regional incident spirals rapidly into a missile exchange across the Middle East. Iran launches large volleys of ballistic and cruise missiles toward Israeli targets. Israel responds with precision strikes. U.S. naval forces deploy missile defense systems across the Gulf. The skies over the region fill with interceptors, radar locks, and electronic warfare. But beneath the dramatic visuals lies the real battlefield: economics. Missile defense is one of the most expensive forms of warfare ever created. A single advanced interceptor can cost millions of dollars. Some estimates place certain high-end interceptors between $3 and $10 million per shot. Now multiply that by hundreds or even thousands of intercept attempts during sustained conflict. Meanwhile, the attacking side often uses significantly cheaper missiles or drones. In simple economic terms, the defender may spend far more money destroying incoming weapons than the attacker spends launching them. Defense analysts sometimes call this the interceptor cost imbalance. And this is where the math begins to influence global markets. Energy traders watch the Middle East more closely than almost any other region on Earth. Nearly 1/3 of global seaborne oil passes through the Strait of Hormuz. Even the perception of risk can send oil prices sharply higher. In a hypothetical escalation scenario, analysts suggest oil could surge within hours, potentially adding tens of dollars per barrel almost overnight. For American consumers, that change travels quickly from global markets to local gas stations. Historically, sudden oil shocks translate into higher gasoline prices within days. For families across the United States, that could mean noticeable increases at the pump, rising transportation costs, and renewed inflation pressure. But the economic ripple effects would not stop at fuel. Financial markets are deeply sensitive to geopolitical instability. In the early hours of such a crisis scenario, global stock markets would likely react immediately. Investors traditionally rotate toward safe haven assets like U.S. Treasury bonds and gold. Meanwhile, sectors tied to global trade, shipping, and airlines could experience sharp volatility. Defense companies, however, often move in the opposite direction. Large-scale missile exchanges require rapid resupply of interceptors, radar systems, and air defense components. Governments may accelerate procurement programs worth billions of dollars. In previous conflicts, defense spending announcements have triggered significant movements in aerospace and defense stocks. But the most complex economic impact may involve global trade routes. The Middle East sits at the intersection of some of the world's most important shipping corridors. Any military confrontation that threatens the Persian Gulf immediately raises insurance costs for shipping companies. Tankers carrying oil, liquefied natural gas, and commercial cargo may face delays, rerouting, or increased security costs. Those costs ultimately move through the supply chain. Shipping disruptions can influence manufacturing, energy availability, and consumer prices far beyond the conflict zone. And yet, behind all of these macroeconomic forces, there are individual human stories. Imagine a long-haul truck driver in Ohio who suddenly sees diesel prices spike after weeks of stability. His delivery contracts were priced assuming fuel costs would remain predictable. Now every mile becomes more expensive. Or consider a small manufacturing business in Texas waiting for imported components that suddenly face delays due to shipping risk premiums in global maritime insurance. These are the quiet economic consequences that rarely appear in dramatic headlines. Back in military planning rooms, however, analysts continue focusing on the same calculation that began this conversation: interceptor math. Missile defense systems are extraordinary technological achievements. They combine radar tracking, artificial intelligence targeting, and high-speed interceptors capable of destroying incoming threats in seconds. But even the most advanced systems face logistical limits. Stockpiles must be manufactured, transported, and deployed. In a prolonged missile exchange scenario, the question is not simply whether defenses work. It is whether they can keep working long enough. Manufacturing new interceptors takes time. Production lines operate under complex supply chains involving advanced electronics, rocket motors, and specialized components. If large numbers are used rapidly, resupply may become the next strategic challenge. And that brings the discussion back to economics once again. Sustained defense spending during a major regional conflict could add tens of billions of dollars to military budgets. Governments would face difficult decisions balancing defense needs with domestic economic priorities. For the United States, these choices often intersect directly with public debate about federal spending, inflation control, and long-term national security strategy. Energy markets, defense budgets, shipping routes, and consumer prices, all linked by the same underlying equation, the interceptor math. Because in modern warfare, victory is not only measured in battlefield outcomes, it is measured in production capacity, economic endurance, and the ability to sustain defensive systems longer than an adversary can sustain attacks. And that is why analysts across Washington, financial institutions, and energy markets watch these numbers so closely. Not because conflict is inevitable, but because preparation requires understanding how quickly the balance could shift. On Crisis Clips, we focus on the intersection of geopolitics and global economics. And this scenario reveals something many viewers rarely hear in traditional news coverage. Sometimes the most important battle is fought long before missiles ever launch. It happens in spreadsheets, supply chains, and economic forecasts. So as tensions rise and analysts continue to run their simulations, one question quietly remains at the center of every strategic briefing. If the interceptor math truly determines the outcome, then in a prolonged confrontation, who actually runs out first?